5 years ago, a debt crisis broke across the world, and central banks, governments scrambled to deal with it. And 5 years later, they haven't dealt with it, and we are still trying to sort out the mess that was created in the credit bubble, which arguably lasted 30, 40 years. So we'll have a distinguished panel to talk about this issue. So we're going to start off with Steve Freidheim, who is the founding partner of Cyrus Capital. If you can come on stage, please, Steve. Thank you. And then Vincent Reinhart is the chief US economist of Morgan Stanley, and Charles Roxburgh, who is the director of the McKinsey Global Institute. Can you welcome to the stage, please? So we're going to try and discuss some of the issues that still face us after 5 years of crisis. So let's start off with defining the problem, if you like. So we know that we have had countries that have got into too much debt, but we also know that over the long term, we've seen debt levels in advanced economies rise relative to GDP. So is it possible to say whether there's a maximum level of debt in an economy? And is it also possible to say that this crisis isn't over until we've got down to some particular level of debt? And I'm talking here about total debt rather than just government debt. So let's start off with Charles.
Well, I think you need to separate public and private debt. And I think on the public debt side, Vincent and Ken Rogoff and Carmen Reinhardt have also done lots of great work with, and also now with the IMF coming in to say there is probably a level on the public debt side that is a maximum level, and below that you do get a restraint on growth. Maybe I should let Vincent talk more about the public debt side. And it's probably somewhere around 90, IMF could argue it's 100, but somewhere in that zone. I think on the private debt side, it's extremely difficult to pick a single number. So people say 500 is wholly unsustainable for the UK. It's too simplistic. You have to look at the individual elements of it and break it down to households, financial institutions, and corporations. And so there's not a single number across all the individual countries. Our view, having looked at this across a whole set of countries, is that there are some countries where household debts are too high and need to come down. Spain, clearly. The UK, probably. The US has come down a lot. Corporate sector actually is not over-leveraged, and except in Spain, where I think, and some sectors like real estate. So the corporate sector, I think, has relatively good prospects. It's got the cash. Hopefully it will invest it soon and we'll get back to growth. So, and then on financial institutions, that's the hardest one and the most controversial part of these total debt numbers. And a lot of people say you shouldn't look at it at all, you shouldn't include it in these total debt numbers. Our view is that you absolutely do need to include it, but then unpack it bit by bit. I mean, the UK's got financial institutions debt around 200% of GDP. Now, is that unsustainable? Well, it depends. Is it going to fall on the UK government or not? Is it foreign banks in London or not? How secure is it or not? We just think that government should have been looking at it more on the run-up to the crisis. It would have been a useful early indicator of some of the massive expansion of the banking sector. So I think on the public debt side, yes, there is a clear number. On the private debt side, you need to look market by market, sector by sector. And there are some sectors, some household sectors in Europe that are over-leveraged and probably do need to come down.
Vincent, what's your view?
So first thing you have to understand is economists are not particularly good at answering this question because our models are not well aligned to it. The key models don't really have important roles for stocks of things and tend to do an enormous amount of netting. And I think that's exactly right. You have to go down to the individual sector level, in which case the answer is not a fixed number. It's also not fixed over time because it depends on how the other sectors of the economy are willing, or what they're willing to allow you to do. So if you can't go to models, you have to go to the past and look for statistical regularities, and you find out they're pretty robust. And for this conversation, there are two important things to know. First, a severe financial crisis cast a long shadow. 10 years after the median experience, after the 15 worst financial crises of the second half of the 20th century, level of GDP's 15% below what the trend of the 10 years prior. That's a lot. And importantly in that is deleveraging. You basically work off the leverage you built up in the 10 years prior to the crisis in a painful 6 or 7 years after the crisis. Second point, which was the work alluded to, public debt's a problem. Carmen, Ken, and I looked at the experience of 22 advanced economies after the Napoleonic War. Countries that have a large debt loads just grow more slowly, they get stuck in debt traps, and they're there for a long time.
Can I just ask, because people often say this, does it make a difference whether the country it borrows in its own currency and has a supportive central bank over whether public debt is a problem?
So it certainly makes a difference when you think about debt sustainability. It's something about the current stock of debt, future debt creation, the cost of borrowing, and growth. Well, if you can affect the cost of borrowing through inflation, then you can make it what is otherwise an unsustainable condition sustainable. So you asked it in the positive light. Another way of saying it is, what happens when a government issues in its own currency and has access to the printing press? The answer is quite often fiscal dominance. That is, central bank action becomes a part and parcel with the fiscal problem.
We'll get on to that later, I think. Steve, now, Carl Bass was on stage here last year. He was saying 150% of GDP is the long-term average, and that's, until we get down to there, we haven't solved the problem. Yeah, public and private. How do you feel?
Yeah, so look, I think there are three factors that will drive that number. One, do you have access to a printing press? So the number is very different for countries that don't have access to a printing press. Numbers can get bigger for those countries and smaller for those countries that don't. Number two is the trajectory of revenue growth. So is the country or underlying companies generating increasing amounts of revenue? And so when you see turning points where companies go from growth to declines, that number shifts dramatically. Mm-hmm. The markets ultimately are going to look for, does this country or set of companies do they have the ability to repay their debts? And so the trajectory of revenue growth is critical. And third factor is time. So that number may work in one period of time, it doesn't work in another period. So it's very difficult to say 150 is the right number. I don't think there's that clear delineation. I think it could work for the United States. It's certainly, up till now, it's a number higher than that's worked for Japan. But you really have to look at the underlines of each situation to make that determination.
But I think from the scale of your answers that all of you agree that maybe we need to come down from where we are. So let's talk about how we get down. So the IMF's report a couple of weeks ago suggesting that fiscal austerity has a much bigger multiplier than they previously thought. So that would suggest that we have to get debt down more slowly than the IMF previously thought. So do you agree with that assumption? And if so, does that inevitably mean it's a very long period before we get out of this mess? Charles, again.
I certainly think it's going to be a long journey, particularly for countries in Europe. And to get the debt down without growth doesn't compute. It's just too difficult. And so I think the shift of the opinion in Europe is now moving more to it needs to be a slightly more paced process of debt reduction, of deficit reduction. And in some countries, there's going to have to be debt write-off in the public and the private sectors. So I think if plan A was do it all through austerity in Europe, I think the view now is that that's just too tough a diet, and we're getting caught in a vicious cycle of no growth, and the deficit reduction is making growth even slower and going negative in some countries. So I think it's going to have to be a much more measured pace.
Vincent?
So it's not just, do you need, I worked at the AEI for a while, often quote Herb Stein, and the thing Herb always said is if something's unsustainable, it stops. Unfortunately, Herb never explained when or how it stops. So I think we can all agree that in many advanced economies, debt positions are unsustainable, something's got to happen. We also have to respect the fact that in many advanced economies, there's a lot of resource slack, and monetary policy is extremely accommodative. That's actually the best condition for fiscal expansion to support economic activity. So we need a debt consolidation plan, not necessarily immediate restraint. Second, we have to respect the political reality, and that is what might work best in an economic model, that is, take advantage of the opportunity to stimulate now and promise later, is probably not politically feasible. So we have to balance the resource slack we have now with the recognition that if a politician promises easy things now and hard things later, it's not going to be credible. So we have to strike that right balance.
Yes. And how would we do that, Steve?
So I'm going to come to the same conclusion. We've studied the economies and balance sheets of the European countries, and have come to the conclusion that some form of debt write-down is ultimately going to be necessary unless we're going to sign up to decades, not years, but decades of low growth, to no growth, and at the end of which it's not clear to me that you're going to get to a place of sustainable, independent debt sustainability. So that gets you to debt write-down. So okay, so let's walk through the issues there. The primary issue there is contagion. So and I'm less concerned about contagion amongst sovereigns. Essentially, sovereigns have the big advantage. So if Spain undergoes a debt restructuring, Italy, and it causes some great panic in the markets for some period of time until the markets figure out what this restructuring means. Italy, Ireland, their debt may trade down significantly in price, but ultimately what you have to cover is the maturities during that period of panic, which is something that can be covered. Sovereigns have this advantage of having a maturity schedule that is extended. Banks, on the other hand, don't have that advantage. Banks have two major problems. Number one, their liability structure can walk out the door when the bank opens the next business day and every business day that they open. So depositors can walk out and they're free to go that morning. So if there is a panic in restructuring, the issue is how do you stem that liability out? Second problem they have is interlinkages. So if you take a look at the derivatives market, there's $650 trillion of derivatives. Each derivative has a counterparty with another bank. So if you take a look at that size, that's a multiple of the total amount of sovereign debt in the world. And these interlinkages are so strong that if you get enough of a panic within certain financial institutions, that will invariably leak out to other financial institutions and can bring the system down, which is what we're most concerned about. So the key to a restructuring is first to firewall the financial system. So that has to get done before we can do it, but ultimately it has to get done.
And do you feel that European sovereigns are strong enough to back their banking system, or is it a case of no? Right?
No. Well, to back their banking system?
Yeah.
No.
So
if you have a run on deposits, which leads to bank failures regionally, that will bleed to other countries, I believe, and the euros are too.
Your
too
firewall is the ECB financing it. Would that be how it was done? If you were trying to create a firewall, you'd say the ECB will step in all circumstances and buy whatever it has to.
Well, what it would need first to be defined is what is the critical core of the banking system, and firewall that.
Okay. Vincent, I just wanted to pick up on your point about the promising in advance. So it's a bit like, all of us promising to go on a diet in 2014, right? But you can have your stomach stapled, so that's a way of cutting back. So is there a stomach stapling measure that you would suggest for us in the West to try and commit ourselves in advance?
So we can point out a couple that don't work. The reason we have facing a fiscal cliff in the United States on January 1st, the equivalent of a 5 percentage point consolidation in our budget, a sudden stop, is basically the accumulation of failed attempts at discipline, the sequester. Other attempts at discipline are using your credit rating, namely threatening to default because of the debt ceiling. Typically, to be credible, you have to legislate phased-in reductions. You have to share pain across your population, lengthening retirement age, phasing in a reduction in tax expenditures. But here's the hardest question, right? Here's the problem. What is the most overvalued asset across advanced economies? The answer is voters' expectation of the net present value of the entitlements they're expecting. Why? Because they by and large don't have a tax system to support that. So the most important thing to do to get fiscal consolidation right is have a conversation with your population that they're not as wealthy as they think they are.
But even if you commit in advance, can the 2013 Congress commit the 2015 Congress to keep going? It can't.
That is the problem of democracies. Sometimes it works. Greenspan Commission in the early 80s did suggest phased-in changes that were supported, and the end means we don't have Social Security in the mix right now. But we got to do those sorts of things right now, or fairly soon they will be in the mix again.
Now, we're going to be in a different world, so we're going to delever some way. But if you think about the way our economy has operated the last 40 years, it's all been about levering. So companies have been encouraged to have more efficient balance sheets with more debt. We've had the growth of the private equity industry, which is a debt finance industry. We've had individuals take on consumer debt, mortgage debt. Can we operate our economy in the way that we've operated it before if people aren't taking on more debt? Raghuram Rajan had this thing about how the middle classes have kept their spending up, let them eat credit. Are we going to be able to have the kind of economy with rising living standards that we expected, for the last 30 years without rising debt? Charles?
Two-part answer to that. First, I think we do need to reset our expectations. And we got accustomed to thinking that trend growth is 2.5%. And I think we just need to get used to it's going to be less than that. I mean, per capita growth has actually been 1.5%, and in Europe, because we haven't got much population growth, the actual growth is closer to that. The US is more flattered by population growth, but actually the US has had 1.5% per capita growth similar to Europe for a long time. And politicians seem to think 1.5 is disaster. I think we just need to get used to 1.5% per capita growth over the long term would be a good thing. I mean, in Keynes's famous 1930 essay, he said that would make our grandchildren, that's the bottom of his range, 4 times wealthier in real terms than they are today. So I think we need to reset to around 1.5% for growth rates. So that's part of the answer to your question. The second part is we have to move the balance between debt and equity more into equilibrium. It is bizarre after a massive debt crisis that governments continue to subsidize debt and have a tax bias against equity. Almost everyone thinks this is a bizarre, self-defeating policy, but it has absolutely no political support to change it. And if we had a serious debate about moving to a neutral tax structure that was not biased against equity, and we got more of the equity culture back, and stopped some of the regulatory biases against equity which are growing up, then we could start to finance growth with a better balance of debt and equity rather than, as we did in the past, too much debt.
Vincent, what do you think?
So here's the good news about the United States. We are incredibly inefficient in delivering fiscal policy, in the sense that our tax system is incoherent, appropriations have no top-down governance, no budget rules, putting guardrails on the process. And so if you're so inefficient, so inside the efficient frontier, there's no one way you have to go to get to a better place. There's lots of things we could do and have a discussion about what should the size of the government be, what should the progressivity of taxes be, how finely niche should the safety net be. But to me, I think means there's the opportunities discussed to level the playing field, to encourage saving more rather than encouraging consumption and be growth enhancing. And if we address what I referred to earlier as the biggest overvaluation, I think we could induce households to change their own behaviors. If U.S. households and in most advanced economies expect too much from the government, they have an overvalued asset, then you undersave and you overleverage.
But let's supposing you convince them all tomorrow. Isn't there a St. Augustine problem here? You want them to save more, but you don't want them to save more now because then consumption would fall and you'd be in a recession. So it's similar with the government sorting out its fiscal deficit. It's always gruel tomorrow and not gruel today. How do you...
That is the fundamental incentive problem. That is why governments promise the pain later on, and why it's not necessarily credible when you start when you announce the grand bargain in the Rose Garden. So I think we got to have that discussion. And if you look at successful fiscal consolidations, they're usually associated with a recession up front. You don't do it for year 1 and 2. You do it for years 3 and 5 and beyond.
And isn't there, sorry, just one other thing. The problem, if you look at successful fiscal consolidations, Canada in the 90s, Canada had America growing gangbusters next door. We're all trying to fiscal consolidate at the same time. And
so there's actually 2 dimensions to that make this much harder than the one-off examples that people give, including the fact that in an open economy you have your exchange rate but in this particular case, number one, we're all trying to do it at once. So you can't rotate demand to your trading partners. And number 2, most countries have a public and a private sector debt problem. Classic example of fiscal consolidation in the U.S. Was working down the debt load after World War II. Well, there was no private debt after World War II, and there was a lot of pent-up demand. So you could rotate away from the government to the private sector, both in terms of spending desires and balance sheet space.
Steve, as an investor, how do you see this? I mean, you know the thesis that Carmen Reinhart has come up with, financial repression. So when we know the Fed is going to hold interest rates probably at near zero till 2015. So the idea of real interest rates being negative for years to come in not just the US economy, but in developed economies, how does that affect you as an investor and how you look forward?
Well, most investors that try to fight the Fed, there's a trail of dead bodies behind them, right? So conventional knowledge would be that you don't fight central banks. They've got much more capital than you do, and they're going to flood the market with capital. Generally speaking, that has resulted in asset bubbles, and then that tends to end badly for those situations. As an investor, we try and, as professional investors, we try and look at situations. And if we're buying a situation, we're buying it based on its fundamental value. But getting back to your question in terms of this question of debt and how much, what's the right, are we doomed to low growth for decades to come? We're involved in debt restructurings all the time. So we look at companies that are overly indebted, and that debt burden has weighed on the companies for years, or quarters of years, and has depressed the growth. There is a process in private debt to restructure those debts to get that debt level back to a sustainable level and allow the company to invest and grow. And I think that's the process that ultimately needs to get done with many of these sovereigns as well. So I think ultimately the end game has got to be debt write-downs. So that's where I come to. Now, as an investor, we build that in. We're ultimately of the view that debt write-downs are going to have to happen.
I want to pick you up, though, on one of the first things you said there, which was that it often leads to asset bubbles. So if you were, and there's all these eager people who'd like to make millions out in the audience, if you were going to say where the next asset bubble is going to occur, where would you think it would?
Yeah, it's very difficult to figure where the next asset bubble is going to occur. I mean, certainly there's a lot of pressure being put on the housing market to get that level back up. We're far away from an asset bubble on that.
German real estate? German real estate's going suddenly?
Yeah, where would I think the asset bubbles are? I'd say treasuries.
Right.
Okay, that's the big one. Right?
Yeah, but you'd think yields would fall even further, and so there's still money to be made by going long treasuries.
When it ends really quickly.
Right.
So I think the biggest asset bubble is probably in treasuries right now at the low yields. And then some certain sovereign debt, which is being propped up.
Emerging markets, commodities, any of those?
We don't really focus on that, but I would say European sovereign debt.
Vincent, do you think that very low interest rates do have a distorting effect over the long run?
Oh, sure. Carmen and I did a paper a few years back about capital inflow bonanzas. And we looked what happens when a country gets a surge in capital coming across the borders relative to its own history. And the answer is, if you get a big windfall of capital, your currency tends to appreciate, your equity markets increase, real estate markets increase, governments believe they're geniuses because the budget balance is going into better position and they decide to spend some more. But But being dependent on the global investor means it goes away at some point, and when it does, that process is reversed, and usually painfully so, because budget positions are stretched, and suddenly you're not getting the revenues you used to. Main point is capital inflow bonanzas can be costly, particularly in smaller markets in the EM space, because the global investor is large and some of those markets are small. And the best predictor of capital inflow bonanzas across the world was none other than the real short-term interest rate in the core. Yeah. That is, low interest rates in the center just creates this incentive to search for yield, and some of that capital goes in the wrong places.
Charles, McKinsey did this big report on the level of interest rates and how it affected the economy going back 40, 50 years, didn't you? What did you find?
Well, we found that there had been a very long-run falling real interest rates, partly the defeat of inflation, but also the falling rate of investment in the Western world. So rather than seeing this as a savings glut, we said actually there's been more of an investment dearth, that the level of investment in the Western economies had been falling. Partly the structure of the economies is moving more to capital-light businesses. Partly it's the fact that you get a lot more bang per buck from buying a computer these days than you did in the 1960s. But the falling rate of investment, and then this surge of savings fell onto a much lower rate of investment. So you got this big glut at the end of it. But we just said, let's look at the whole process of this long-term trend downward in investment, coupled with a sudden surge from the east of excess savings. And you got this bubble that we saw in the build-up to the financial crisis. And I think looking forwards, the big question is whether whether the investment rate in China, which is now such a material part of the global investment and savings pattern, if that continues, then more of the Chinese savings, given their demographics, may stay back in China, and we can't rely on excess savings out of the East to fill the gap on our side. So I think the big uncertainty as to future interest rates will, in addition to the fiscal policy over here, will be whether the Chinese incredible levels of investment continue, and you get the two schools of thought. Some think that's the big bubble and about to come crashing down. Our view more is that this has still got another 10 years of significant building still to go to build out the whole industrial and urban infrastructure in China and then in India, and that there'll be a lot of investment still in emerging markets, and that therefore our savings rates will need to go up because we'll be more dependent on funding our own needs here rather than relying on importing savings from the East.
Thank you. Now, there's, before I open up the questions, one other thing I wanted to raise with you, which is that the possible next governor of the Bank of England, Adair Turner, suggested that one way to deal with this crisis is for central banks to either forgive the debt that they've already bought from the treasuries, or to convert it into some long-term loan, a 100-year loan with zero interest rate or very low interest rate. That might cause panic in the markets, it might cause downgrades by the rating agencies, or it might be the master stroke that solves this crisis at one move. I just wanted to see what you thought of that concept. So, Steve.
Okay, well, let's take Europe. Let's start with Europe. So, because I think the U.S. is a completely different situation. So, in Europe, you're essentially the markets would be concerned about the creditworthiness of the. Let's take the periphery for starters, and where does the debt that the central bank hold reside within the priority of payments? Are they going to come out first? Are they not going to come out at all?
If they forgive it, they wouldn't come out at all, yeah.
Yeah, I think I think the idea that they would forgive it is highly, highly unlikely. Whether it would be restructured into a different form of debt, which has a lower interest burden and extend the maturity, that is a possibility. So, if you take a look at the Greek experience, the private investors took the initial hit, and then the question is, okay, what's the ECB going to do? So what are they going to do with their $170 billion in debt? I think to the extent that they did restructure that debt and extended the maturities of debt without even, they don't really have to change the debt amount, but restructure in such a way that lower the interest rate and extend the maturity profile, that would give a lot more confidence to the public markets to invest. Because right now, the public markets, it's very difficult to invest in any of these sovereigns because you don't know where that resides. Paris Club's been very clear that the IMF comes out first because that's emergency funding that came in. So that comes out first. It's unclear exactly what the ECB is. Is this emergency funding? Is this part of a sustainability concept, which is going to come out first? Paris Club's also been pretty consistent that debt that's been restructured is exempt from the re-restructuring of the debt, or at least if it's taken a 70% hit, everybody else got to take a 70% hit before it gets restructured. So, how these concepts get implemented, and the more clarity you can get to the market about how these priority of payments go, that's ultimately good in getting to a long-term functioning capital market.
Vincent, I mean, the Bank of England owns a third of all UK government debt, so we kind of got to the heavy petting stage. Mm-hmm. Is there any problem if they go all the way?
Okay. So that goes back to the initial observation. Why would a country default if it's issuing currency, if it's issuing debt in its own currency and has access to the printing press? The answer is historically there are episodes of such countries defaulting, but most of the time you get fiscal dominance of the central bank. This is an example of fiscal dominance. There are three issues to think about here. Number one is the precedential nature. If you do it once, then what makes you think you won't do it again and again and again? That does then call into question the anchoring of inflation by that central bank if it is now a secondary position in the government. Part two, it does depend on how the central bank reacts to its impaired capital position. In principle, if you have access to the printing press, you're issuing a fiat currency, the central bank doesn't need capital. But most of them do, and most of them care about it. And if the next thing after that conversion, the central bank starts trying to rebuild its capital, it actually has an effect on the government's deficit. So there's an unintended fiscal consequence. Third part, it's been done before. It's been done in the United States. March 8th, 1951, the Treasury swapped out the Fed's holdings of marketable short-term securities for a special issue, 29.5-year nominal bond that was non-marketable and yielded 2.5%. So in one stroke, the Treasury lengthened the maturity of its debt, locked the Federal Reserve's balance sheet in place, and commanded real resources. Because I'm pretty sure a nominal security earning 2.5 and maturing in 1980 didn't have that high a return.
Wasn't a great investment, and the world didn't end.
And the world didn't end.
Charles, what do you think?
Well, I thought it was a brave and important speech by Adair. Brave because to set out a controversial position in the middle of this very public selection process for the governor of the Bank of England was quite a brave thing to do. It could have been easier to keep his head down, but he set out this quite controversial view that they need to think of a very broad range of unconventional measures. I think it was important because we do need to move beyond the rather sterile Plan A versus Plan B debate that we have going on in the UK and frankly in Europe. Is it austerity over 5 years or austerity over 7 years? It'd be nice to get a slightly richer set of policy options on the table. And I think Adair Turner was right to force the debate. So I think we need to go beyond Plan A, Plan B. We need to have a much broader debate of Plan C, D, E, F to see what the full set of options is. I'm personally not yet convinced that we're ready to move to this option. And in Adair Turner's defense, he didn't say cancel the debt. He actually just said, let's look at a broad range of unconventional measures, which is then interpreted in the press to mean all sorts of very unconventional measures.
Somebody leaked to give that interpretation.
Yeah.
I want to throw it open to the audience, so if you can raise your hands with a question. A moment. Okay, so I'm going to ask, 2.5 years ago, in Economist, we ran a survey on debt, which I wrote, and I outlined the potential solutions to this crisis as inflate, stagnate, default. And Steve, I think you're going for default, which is what...
Well, selective default, right?
Selective default.
So if you take a look at the banking system, the best estimates I've seen, most credible estimates I've seen, $2 trillion of losses that ultimately have to get recognized by somebody at some time. So that there would be some restructuring there.
I know we've got a question, so I'm going to
are going fine too.
Ask the other two. If you had to choose between those three options, you'd go for how we get out of it.
My prediction is it's going to be financial repression.
Okay, which is mini inflation.
Which is some controls on finance plus a little bit of inflation.
Okay, and Charles?
All of the above.
All of the above, just to be, there's a question on the side here, yes.
Greg up with The Economist. You say financial repression like it's a bad thing, but is that actually not such a bad way out of this? Vincent, one of your co-authors, Ken Rogoff, is on record as wanting a higher inflation rate, which is arguably a form of financial repression. Is that, in fact, perhaps the least bad way out of this?
Yeah, so a couple points. First is, in the advanced economies, we never really had a discussion about what the right inflation rate should be. It just so happened that at a formative stage of the discussion, inflation happened to be 2%, and we settled on that as a definition of price stability. So I think we need a better debate about what the right way to anchor monetary policy in the long run. Part two, why call it financial repression? That's a charged term. You're exactly right. Fiscal consolidation is about sharing the pain and trying to use every single margin you can. One particular way is tax wealth in the form of restrictions on finance and a little bit of inflation. We call financial repression for a reason. It happens to be an opaque tax. And opaque taxes get overused, give it a bad word, and it draws a little more attention. Second reason is, for the past 30 or 40 years, whenever an emerging market government did any of those sorts of things, the Washington consensus was to label it as financial repression. Now that the advanced economies doing some of those same things, we're finding much more virtuous words to describe it.
Okay. Let's, as a gentleman up there.
Of Chicago. I'm for the default option, but the one problem that I think was raised is there are a lot of soft claims like retirement, entitlement, etc. So it's kind of easier to some extent. We negotiate the debt claims. It's more difficult to renegotiate those other claims, but if you don't renegotiate those other claims, you're basically changing the priority structure in a major way. So what are your suggestions on how to do that?
Steve, I know you feel strongly about this.
Yeah, I think the first, you gotta get a firewall system in place, right? So if you start taking the losses today, which ultimately we're going to be true losses in the banking system, that to the extent that that is not firewalled, it can have very negative impact. But
the entitlement claims.
Look,
point.
I mean, one of the issues is, you know, in all the studies that are done, very, very rarely are the entitlement claims mentioned. You know, in the McKinsey study, it's very difficult to assess. So the U.S. looks like we've reduced total debt, but we've clearly increased the entitlements in the U.S. during this period of time. So maybe our debt is actually not looking as good relative to our competitors as we've had. But investors tend to be more realists, so they look at the situation and they say, okay, is this ultimately sustainable? And if it's not sustainable, then it's going to be very difficult to finance.
Charles, did you make any attempt to quantify these claims?
We didn't. I mean, it's an absolutely fair point that they're out there and they're hanging over a number of governments with a real problem. That said, governments can and have addressed them. It's a political rather than economic problem. And if you move the retirement ages out in Europe in line with life expectancy, you can solve quite a lot of the problem. Some countries have done that, others are going in the wrong direction, but that's a policy response that's within the gift of governments if they're brave enough. Public sector unions are proving much tougher to change the benefits on pensions, and that may be why inflation may be the only way out there if you can delink them from inflation. But I think that governments will end up moving a lot more on these entitlements. They'll have to, and therefore today's very scary headline numbers, because you can convince yourself you've got 3, 5, 7 times GDP in these entitlement programs if nothing happens, but something will happen. But it's going to require brave political leadership to make it work.
Well, I know in some states, Illinois, for example, pensions, state pensions are constitutionally guaranteed, so it's quite difficult to get rid of them. But we have a question from Twitter. We're in the modern era here. Any risk of the US or Eurozone suffering the same afflictions that Japan has had with the deflationary trap over the last 20 years? Vincent?
So we are similar to Japan in an important way. Our fiscal process is not disciplined by markets. In Japan, they can continue to sell debt because they have repressed domestic savers. In the U.S., we can continue to sell debt because foreign official entities view us as the reserve currency. Where we're importantly different is our fiscal process is disciplined by voters in a way that doesn't seem to be evident in Japan. In some sense, the big mystery about Japan is why you could go for 20 years with unfair representation in the over-subsidizing construction and agriculture, and continue with unfair generational and accounting entitlements, and why voters haven't rebelled. I'm a little more confident in the US we will continue to have voter anger forcing change. Now, voter anger is importantly incoherent. The best way to describe the US political process is the little circular Roomba that cleans my living room floor. It has no intelligence, it goes in a straight direction, hits the wall, then bounces off. But you know, at the end of the process, it cleans the whole rug. If there was an intelligence guiding it, that's actually called political leadership, then it would happen a lot faster. But in the US, it will happen. It may wind up being more costly than it would otherwise, but it'll happen.
Do you think that it needs, Peter Orszag was on the panel last night, that you have to take democracy out of it and then pass it to a commission and just say, Bowles-Simpson, have one vote, Bowles-Simpson, yes or no? Charles, what do you think?
Can I defend democracy? It may be rather unfashionable on these topics, but whenever, in Europe, whenever voters have been given a choice, they've actually made a pretty responsible choice. They may well have thrown out the incumbent government, but they've elected the opposition on the same program of reform. You know, we've not had populist parties looking for massive exiting the euro in some irresponsible way winning. So I think when put to the test, voters have actually been responsible. And it's very easy to say we should move to some benevolent dictator and they'll solve it all out. I think so far, democracy, it's been messy. It's always intended to be messy. That's part of its appeal. But it's been messy. But in the end, they've taken responsible decisions, and I think we should stick with it for the time being.
Well, that's a good optimistic note on which to finish. So I'd like you to thank the panelists very much for their views.